Good morning, viewers. Now I am going to teach accounting for partnership firms. So in this chapter, you have to learn some basic concepts before preparing financial statements of this business. In the sole trading business, as there is only one owner, so that is why already in the 11th class itself we have learned to prepare the financial statements. Here, some basic concepts are required. I am briefly reminding you. First one, features. Features of partnership business. First one, number of partners. Number of partners. In partnership business, there must be minimum 2 persons to start this business, and the maximum membership is restricted to 100 as per the Revised Companies Act 2013. So that is the one of the feature. Second one, business. Here, partners must continue their business for many years. Mere owning 2 or more partners a building temporarily for 1 year or 6 months, then that is not called as partnership business. So if we want to call this business as partnership business, then purchase and sales must be continued by partners for many years. So that is why business must be continued for many years. That too, legal business must be started and continued for many years. Illegal businesses are banned as per the Partnership Act 1932. Similarly, third one, agreement. Partnership comes into agreement through an agreement. Such agreement consists of some terms and conditions relating to business. These are decided by the partners by sitting together. Such agreement may be either in oral form or in written form. But written agreement is desirable because no partner can avoid from his or her promises made to the business. So that is why written agreement is desirable. Next one, liability. Liability of each and every partner is unlimited as per the Partnership Act 1932. That means if the firm's property is not enough to pay off the debts, then partners are required to sell their personal property and deposit the required money to pay off the remaining liabilities. So that is why partners' liability is said to be unlimited. Next one, mutual agency. Mutual agency. So here this feature is very, very important. As per this feature, every partner plays 2 kinds of roles. First one, principal. Second one, agent. So principal means, these are legal terms. So principal means owner, agent means servant. So each partner acts as owner as well as agent to other partners. That means, as per this feature, if any or a few number of partners are appointed as managing partners by other partners, and if any wrong actions of the managing partners caused for loss, then such loss must be shared in by all partners. So that is why this feature is very, very important to run the partnership business. So this is the other feature. Next one, registration. Registration. To get registered, this business is voluntary or optional. So if the firm wants to get registered, then they can do so. If the firm is not interested, then without having registration, it can do business. But registered, if the firm gets registered with the register of the partnership forms, then it would be desirable for the for avoiding many legal complications. So that is why getting registration also desirable. Next one, profit sharing ratio. Profit sharing ratio. As per this feature, all partners must share profits and losses equally, irrespective of their capital contribution. If the specific, until and unless specific mentioning is there in the agreement, then profits and losses must be shared equally. So, based upon these features, now we can define business as following. So, partnership business may be defined as a business which is run by 2 or more persons for sharing profits and losses is known as partnership business. Another definition, as per the Indian Partnership Act 1932, Indian Partnership Act 1932, it is defined as a relation between persons to share profits managing by either all or any one of them on behalf of all. This is the definition given by Partnership Act 1932. So, based upon these definitions, we can derive these features. So, these are the features of the partnership business. Now, partnership features over. Next concept, partnership deed. Partnership deed. Deed, agreement, contract, these three are same meaning. So that is why partnership results into the partnership comes into agreement. Partnership comes into existence through an agreement or deed or contract. Such a deed consists of the following elements. There, first one is name of the firm, address of the business firm, date of starting of the business of the firm, names of the partners and their addresses, names of partners and their addresses, rules to be followed while opening bank accounts, rules to be followed while admitting a new partner, rules to be followed while retiring a partner, rules to be followed at the time of death, at the time of dissolution. Similarly, rules to be followed at the time of auditing, appointment of auditor, etc., etc. So, if any of the matters are not covered by the partnership deed, then such a matters are to be dealt with by applying the provisions of Partnership Act 1932. Now let us look at the provisions of Partnership Act 1932. Provisions of Partnership Act 1932. So normally, as just I stated now, partnership results from the results of the agreement. Such agreement may be either oral or written. Written agreement is desirable. If any of the matters are uncovered by the partnership agreement, then we need to apply provisions of Partnership Act 1932. They are as follows. First one, interest on capital. Second one, interest on drawings. Third one, interest on advances. advances/loan. Fourth one, profit sharing ratio. Fifth one, remuneration. So interest on capital. No partner can claim interest on capital if it is not mentioned in the agreement. If the interest on capital is mentioned in the agreement, then interest on capital can be allowed. If the interest on capital is provided for in the agreement, but rate of interest is not mentioned, then as per the 6% interest on capital is to be provided for. Next, interest on drawings. No partner is charged interest on drawings also if it is not mentioned in the agreement. If it is mentioned in the agreement, if the rate is not mentioned, then as per 6% interest on drawings will also be charged to partners. Next, interest on advances and loan. Advances, apart from the capital contribution, if any of the partner provided loan to the partnership firm, then at the rate of 6% on this loan, interest is to be paid. Next, profit sharing ratio. Here, if the profit sharing ratio is not mentioned in the agreement, then profits and losses must be shared all partners equally, irrespective of their capital contribution. Next, remuneration. Remuneration means if any partner, no partner can claim commission or salary, other remuneration for the services rendered in the partnership business. If it is provided for in the agreement, then it can be provided. If it is not mentioned, in the agreement, then no partner can claim any kind of remuneration. So these are some of the important aspects as per the Partnership Act 932. If these matters are not mentioned in the agreement, then we need to apply provisions of Partnership Act 932 like this. Similarly, if any of the partner gains any profit by selling the goods of partnership firm secretly or by using partnership firm name, if any profit or gain available to the partner, then such profit must be deposited with the partnership firm. Similarly, if any of the partner opens a competitive firm against the original partnership firm and earns some profit, such profit shall also be deposited with the original partnership firm. So these are the provisions to be applied. If these are not covered by the agreement, then as per the provisions of Partnership Act 932, we need to settle disputes if any started among the partners. So with this provisions of Partnership Act over. Now special aspects of partnership. Special aspects of partnership. Partnership accounting. So, for preparation of financial statements, same procedure as in the sole trading firms is to be followed. That means trading account, profit and loss account, balance sheet, these three statements are also be prepared here. Similarly, apart from these three statements, the following aspects are to be considered. They are as follows. First one, maintenance of capital accounts. Second one, distribution of profit. Third one, past adjustments. Fourth one, reconstitution. Reconstitution of firm. Fifth one, dissolution. Dissolution of firm. So, maintenance of capital accounts, distribution of profit, cost adjustments, these three topics are covered in this chapter and the rest are covered in subsequent chapters. Now I am going to explain in detail one by one. First, maintenance of capital accounts. So first aspect in this account is maintenance of capital accounts. Here, on the name of each and every partner, capital accounts are to be opened and some adjustments like interest on capital, interest on drawings, interest on loan, salary, commission, share of profit, loss, etc., etc. To provide all these adjustments is the other specific aspect. So maintenance of capital accounts along with the adjustments is the one of the important aspects. So for maintenance of capital accounts, there are two methods. They are as follows. First one, a fixed capital method. A fixed capital method. B, fluctuating capital method. So there are two methods for maintenance of partners' capital accounts. In fixed capital method, here two separate accounts are to be opened on the name of each and every partner. They are, one is the partner's capital account, second one is partner's current account. So now I am going to give formats of accounts to be opened here. One, partners capital account. Partners current account. So this is the debit side, this is the credit side. First, in the partner's capital account, what matters are shown here. As the name itself stated, the transaction related to the capital must be shown in this account. Opening balance. If the last year any capital balance is there, then that closing balance must be taken as opening balance to the trade side into this account. By balance brought down. Generally, in this method, partner's capital account shows same balance year after year, but there may be some additional capital introduced or some existing capital may be withdrawn on permanent basis. If such adjustments are there in the capital, then they must be shown. Additional capital must be shown on the credit side by bank. It is for additional capital. If any part of capital withdrawn, then it must be debited to this account, to bank. Permanent drawings. Permanent drawings. After that, this account must be balanced. Normally, this account shows trade balance. Then, such trade balance must be shown on the debit side like this. Balance carried. So, like this account must be maintained on the name of each and every partner. So, as this account shows, as only capital transactions are recorded in this account always shows trade balance. Similarly, this account shows always constant balance unless any part of capital introduced or withdrawn. So, apart from this account, one more account to be opened on the name of each partner is current account. Opening balance, if any last year balance is there related to current account, then that must be taken to the trade side if that is the trade balance. By balance brought down, if it is trade balance, if it shows debit balance, then to balance brought down, it is for debit balance. After that, other adjustments by interest on capital, by salary / commission, by profit and loss appropriation. It is for share of profit. It is for profit. Similarly, to drawings, to interest on drawings, So, like this, adjustments are to be shown in this account. After that, this account is to be balanced. Generally, it shows credit balance, then to balance carried down. Sometimes it may show debit balance. In such case, by balance carried down. So, like this, on the name of each and every partner, 2 accounts are to be worked. Okay, thank you.